Hi, and welcome back to the Gray Report Podcast. I'm Griffin Haddad, your co-host of the Gray Report Podcast. Today, we've got an awesome episode lined up for you, and we're happy that you're here. Spencer Gray, host of the Gray Report Podcast, is out of office on family vacation, but he's making a special stop virtually into the podcast because we have friend of the pod and chief economist at RealPage, Carl Whitaker, with us this week to break down the market fundamentals, give his forward-looking approach at the rest of 2026, and we're going to put him on the hot seat in delivering multiple questions to kind of pry and pick at his knowledge and his expertise. Stick around. We've got a great episode of the Gray Report coming up. Thank you for being here. Welcome back to the Gray Report Podcast. I'm Griffin Haddad, and as promised, Spencer Gray joining us virtually from family spring break. But the focus this week is on our special guest, friend of the pod, chief economist from RealPage, Carl Whitaker. Thanks for joining us this week, Carl. It's great to have you here. We always start off the podcast just by asking, how are you? How are you doing?
Good. Yeah, I appreciate y'all asking. This is ashamedly actually my first time in Indianapolis. We had a road show that we're meeting some clients up here. So first time in Indy. I don't know if late March is necessarily the primo time to visit, but I am glad that we're not here next week. I think it is because the Final Four is downtown. So I imagine it'd be a little bit more crazy than a Tuesday, Wednesday in late March.
Right. I feel like you caught us at a good time in Indy. We're just getting into the springtime weather. Like you said, we're in between kind of large events here. And so it's a good time to be in the city. Happy that you're here this year. I'm looking forward to kind of diving in. You mentioned you're on a road show here in Indianapolis. Yep. It's your first time. Just give me kind of a brief understanding of, what's the purpose in you coming to Indianapolis? What was the event that you were at this morning?
Yep.
And then, who was also in attendance?
Yeah, and we were talking a little bit about this in prepping for the podcast here, but Indianapolis is kind of quietly a bit of a hotbed for some pretty big multifamily operations organizations, both for market rate and affordable. I think Spencer was saying that Indy kind of punches above its weight in commercial real estate in general, which I would 100% agree with. But we had the idea to bring together a bunch of Indianapolis-based clients and almost kind of do like a lunch and learn. It was a little bit more than just a lunch and learn because I kicked things off with a market update, national trends, what's happening in Indianapolis, encouraged questions along the way. Then we had one of our other senior leaders come in and talk a little bit about what RealPage is doing on the agentic AI workforce and giving an update there, just what to expect, what lessons we're learning. Obviously AI is at the forefront of, I'm sure, not just multifamily, but probably every industry these days. So yeah, it was just kind of a quick peek behind the scenes and seeing what RealPage is doing. And we also learn a lot from coming to cities like this because we get good boots on the ground perspective. And at the end of the day, if I'm talking about a city that I haven't physically been to and visited yet, it's a little bit harder to talk about what makes that city tick. So I thought it was good to drive from downtown to the office here and hopefully get to make it up to some of the northern suburbs to see what's going on in Hamilton County, for instance.
Oh man, you're in for a treat.
It's some incredible supply up there, which we can get into in a little bit. But yeah, hopefully that's not too long-winded of a backdrop.
No, absolutely not. I appreciate that backdrop, and what an event. Sounds like a really cool collection of people, and just the conversation topics seem very on point and very directed towards the industry in commercial real estate, specifically multifamily that we have here in Indianapolis. Looks like we've got Spencer back. I wanted to see if I can bring him back in just to check on him. And again, thank you for joining us on your family vacation.
Carl, how's it going? Can you hear me?
We can hear you.
Awesome. Sorry about that. Technical difficulties. Carl, again, I apologize. I'm not there in person. Show you right in Indianapolis, at least give you an office tour. What do you think so far? I guess downtown to Indy, it's like you said, you haven't gone up to the northern suburbs up in Hamilton County, but what are your first impressions?
Honestly, it's really hard to say. I got in at like 7:30, 8 p.m. last night, so basically got to the hotel, went to sleep, and our meeting started at 8:30 this morning. So
right.
my Indy experience thus far has been walking from one end of downtown to the other to get from one hotel to the next. So, but I'm hopeful that tonight we're going to a Pacers game, and I'm hopeful that between now and then I'll get to explore a little bit more in the city.
Right. We will be cognizant of your time to make sure you can get a little bit of maybe a foot or walking tour of downtown. But like I said, it's a great time of year to be here. Indianapolis is such a walkable city. So even if you just need a 15-minute break, take a lap around the block. And then the next time you're in town, maybe we'll like to share around the north side suburbs, maybe myself or with Spencer, just because there's so much little nooks and crannies and special places to grab lunch along the way that it would be great to be able to do that. So,
Yep.
Well, awesome. Spencer, do you have any burning questions just right off the bat for Carl?
So we've been talking about Indianapolis, and a repeated topic on the Gray Report is this dynamic between Midwestern markets, Sun Belt, and also kind of the Northeast and some coastal markets that are a little bit outliers, like San Francisco. Are you still seeing that same dynamic? I guess the Midwest kind of pulling away and separating itself from the Sun Belt, or are we finally starting to see some of those Sun Belt markets start to really take advantage of their high absorption rates and start to make some progress, whether that's on the occupancy front or rent growth?
Yeah, I like the framing, and I'll even start kind of a little bit of a quip that's a little tongue-in-cheek, but also has some seriousness behind it. For the past decade, it seems like the conversation has always been Sunbelt versus Gateway, and totally glossing over the fact that we have 30 states in the middle of the country that comprise, I'm being generous in saying the 30 states that make up the Midwest, but, there's this huge swath of the country that has some of the nation's biggest markets that have just kind of been forgotten for a better part of at least one cycle, if not two cycles. That does seem to be changing a little bit, and I think a lot of that's because of the stability that the markets have proven this particular cycle. A lot of people will be quick to say, oh, well, it's because the Midwest hasn't had any supply. Let's not forget that Indianapolis, Chicago, suburban Chicago, even the Loop and within the downtown area, Columbus, there are a couple of Midwest markets that actually have seen some supply. It's not just Detroit and just St. Louis and just Milwaukee. So I think demand fundamentals have actually been pretty decent here too, and that sometimes gets glossed over in the broader discourse. Now, you did mention the Sun Belt markets. I think what we're seeing more so in the Sun Belt is that, I guess let me take one step back. Your question was, are we seeing some separation between that coastal profile, Sun Belt profile, Midwest profile? Unfortunately, I think we're kind of seeing overall coalescence of those three distinct geographies towards a national average. And unfortunately, the driver behind that is just sluggish performance, mostly across the board, not every single market, but most markets running below their long-term averages. The Sun Belt in particular, if you kick out maybe Austin, which is kind of on its own cycle, and maybe Phoenix, which is on its own cycle, we're seeing that there's maybe some stabilization, but stabilization at a low point. Now, going into 2026, one of our prevailing ideas was that as those markets stabilize, Spencer, you and I were talking just before we kicked the podcast off here, as those markets stabilize and kind of gain back some of that occupancy that they forfeited during the peak supply period, I think we could see, just by simple nature of how averages work, the weakest performing markets, as they get back closer to 0%, well, that's going to raise the overall region's average. Unfortunately, it's just raising it back closer to a flat level rather than a declining level. The gateway markets are also kind of a fascinating little case study right now, where you have the West Coast, which is rocking and rolling, minus Los Angeles, which has some underlying demand challenges. You've got New York City, which is doing fantastic, but Boston and D.C. are also dealing with some policy influence demand challenges. So there's still a lot of market level splits and bifurcations, but it's not necessarily as pronounced as it was, say, 2 to 3 years ago when you had big outliers on either end.
It's very interesting. Spencer and I talk, week after week about just the stability of the Midwest, and you had mentioned it, previously in that answer, talking about Austin and some of the markets that are stabilizing but at a low point. I hate to ask you to make a call if that's the bottom for those markets, but it seems like you're mentioning somewhat of a trough. And so just in relation to some of these markets that are stabilizing at a low point with the stability of Indianapolis, would like to think that with all of this interest, from allocators in the Midwest, we're seeing population growth, we're seeing job growth, seeing wage growth here in Indianapolis. We also saw a healthy dose of supply. I think was much needed. But with all of these kind of tailwinds behind us, I feel like we're through a lot of the headwinds. I want to ask you to maybe piggyback on that answer for where do you see the Midwest and its regional kind of wholeness? Where do you see it progressing to the back half of 26? Because amazingly enough, we're already through the first quarter.
Yeah.
And so it's time to start looking at that back half of the year, especially on the operator side. Yep. We're getting ready to enter into busy leasing season. So I'm just curious as to where you see the back half of 26 for the Midwest, kind of in regards to potentially, hitting that trough or that stabilization at a low point.
Yeah, no, I like that breakout. I think the big thing, and this is true not just for the Midwest, this is true for just about every market not named San Francisco right now. Mm-hmm. The big key in 2026, especially as we get into the second half of the year, is simply going to be avoiding the slowdown that those markets saw in 2025. And really, 2025 even in itself was kind of a tale of two halves. And anecdotally, that thesis was supported this morning in conversation. And what I mean by that is month-over-month rent change, January 25, February 25, March 25, by no means the strongest year we've ever seen on record, but all three of those months had recorded both positive momentum versus the prior year, and we're actually getting closer to long-term averages. So I think that at that point we were seeing, hey, demand is starting to build, and I had made the joke at one point that we were starting to see the bunny slope of rent growth return. It wasn't significant, but there was a little bit of a slope there. The second half of the year, that momentum came totally undone. I think a lot of that was due to the slowing job market, due to maybe some spooked consumers and businesses alike. I think businesses entered the second half of 25 with a lot of caution. Now, the good news from an apartment performance perspective is January and February, and from what we've seen in the prelim March data, that momentum that we saw in early 25 also looks to be building, and that's true in most markets. But again, can we avoid that second half slowdown? And that's just the 2026 outlook. I'd be happy to talk about some long-term perspective too, but I love that you kicked that off talking about population growth in the Midwest, because I'll quickly revisit that idea that the Midwest was kind of glossed over for the past two cycles. One of the big narrative changes I think we're seeing is that some Midwest areas are actually gaining net positive migration, driven by attractive affordability, driven by more flexible working arrangements. And at the end of the day, I think that, if there is a quote unquote positive to some of the long-term impacts of climate change, it's going to be that the Midwest is a little bit more palatable to live in some of the winter months. I don't know that that's necessarily driving demand back here right now, but if we're looking long-term, I think it's at least a consideration in terms of how the Midwest regains population.
Yeah, it's very interesting. And go ahead, Spencer.
Oh yeah, well, I would just say it is an interesting dynamic, Carl, that we've been noticing, operating in these markets, being in the Midwest over the last couple of years, is that net in migration is starting to pick up. I think largely it's driven by affordability. I would love to go back just kind of what you were just talking about of seeing some positive momentum early on in the season, because it was a little bit of a gut punch last year. We saw some strong growth in March, which was earlier than different. We've had like a shakeup of seasonality, which is interesting. But then March and April were the peaks last year. And we never really saw growth in kind of, May and June, which we typically see seasonally. So, I guess I'm curious, what are any early signs of a trajectory? But will we then know by, call it May or June, whether we're seeing a year that could potentially surprise a repeat of next year, or are we going to have to wait for the latter half of 26 when that supply wave is have crested to actually see the growth? But are there enough leases expiring at that time of the year to make a difference?
Yeah, I'm gonna hate my answer here, but the answer is it depends, and the reason I say that is that the first half of I will say that I think March and particularly April are going to be super, super important for the trajectory of the rest of the year. And if we don't have a strong March and if we don't have a strong April, I do think it's going to be hard to regain any significant positive momentum in the back half of the year. But by that same token, if we can, like I said earlier, just avoid the shock that we saw in the second half of 2025, even if we see cuts to month-over-month rents in the back half of 2026, simple arithmetic says if it's a smaller negative than the deep negative we saw last year, that's momentum. So I think that it will be. I think the year will be heavily predicated upon what happens in March and April, or I guess we're through March. So what the March final stats say, but again, the back half of the year, just avoiding that big slowdown that we saw from the prior year, which I think we will, but if we can avoid that, then the market's at least at a point of stabilization. I know, Griffin, you mentioned earlier, have we found the bottom, or are we calling bottom? I think for most markets we probably are. I just don't know how fast that improvement on the backside of that bottom. Is it more of a U shape? Is it more of a V shape? Is it kind of a W shape? I tend to think probably a little bit more of a flat U shape.
Okay.
But eventually it will. Eventually it'll work itself out.
Yeah, understood. Just kind of coming up out of the bottom. Obviously, the fundamentals of supply and demand, they need to be more in favor of, I guess, higher absorption rates, lower vacancies. In the Midwest, we've kind of long had lower vacancies. We've just had what I think is maybe one of the greater supply or delivery years, was 24 and 25. You'll see it on the north side, I think, predominantly. And the markets that Gray Capital specifically is focused on, we're trying to find, that not undersupply, but there's obviously a healthy absorption in the market. And we'll talk about absorption a little bit later on. But when you're talking about coming up out of that U shape, can you paint a picture of what really kickstarts that? What gets that started? Because I think there's a lot of ways that you can start to come up from the bottom. But just curious, let's just use Indianapolis as an example. We talked about job growth, wage growth, population growth. Just kind of explain how we get up out of that trough.
Yeah, so I think the biggest way to get up out of that trough is the drawdown in supply and what's delivering. And I'll use maybe a poorly crafted analogy here or aphorism, but it doesn't take long to fill an 8-ounce cup, even if it's a slow, steady stream of liquid flowing into that cup. It takes a lot of liquid to fill the ocean, no matter how fast that flow is. So I kind of liken that to supply and demand. The Sun Belt, for example, we've seen tremendous absorption. It just takes a long time to fill all the inventory that's been delivered. Okay. Indianapolis is a bit of a microcosm where the past 2 years we've seen quite a bit of inventory growth. And believe it or not, the past 2 years, Indianapolis alone has grown its existing base by nearly 10%. So that's a lot. For every 100 units that existed at the end of 2022, there's been almost 10 more added in just the past two and a half.
Yeah.
Yeah. As exciting as Indianapolis is, I mean, that supply is certainly affecting, rent growth and occupancy. And I think there's some operators out there that are looking at the Midwest, looking at Indianapolis and looking at Columbus, that are seeing them as emerging markets, or other folks are. But the reality is, regional, local developers and some national folks have already, been here for a while and saw the signals, the demographic signals, especially in like suburbs like Hamilton County. And so it's some folks may be surprised they're a little bit later than they'd want to be. One question before we get into the jargon bin, Carl, is that, talking about the setup of multifamily fundamentals, but there's a wrench that's been thrown in the gears of the whole setup right now. Whether, on top of, low employment rate, basically kind of flat, really not adding new jobs. Immigration, obviously, huge drawdowns, which is not helping. But then also now we've got this war, which we don't know what's going to happen tomorrow. But, oil is, I haven't checked it today, but, anywhere it's been fluctuating between, $90 and $120 a barrel. And, there's talk of, depending on what happens, it could go to 150 or 200. And, that impacts consumers and renters and interest rates. We don't know how any of that's going to impact anything, but I'm just, where is your head at? And what do you think of this current dynamic that we're all living through?
Yeah, I wish I had a crystal ball to know where West Texas Intermediate prices and just oil, the price of oil is going to be. And like you said, who knows even what next week looks like. Going into 2026, some tailwinds for the industry, and I'm really focused on demand here. Some tailwinds we had keyed in on were cooling inflation, persistent wage growth, and wage growth has been pretty strong, and I think that's kind of been this quiet strength in the market that's maybe unlocked some demand. And we talked about how strong resident retention has actually boosted the occupancy baseline. And then there's some ancillary components in there too. Keeping a resident in place means that you're not having to pay turnover costs. You don't have a long, prolonged days vacant upon that resident leaving. You don't have to pay as much marketing costs to get somebody to backfill them. So there's a lot of other things that can feed into that discussion too. But some headwinds we had identified, of course, the labor market was the one that was everybody rightfully keyed in on at the beginning of the year. If not for education and health services, we would be in a jobs recession right now, and we're barely avoiding that just because of that one particular sector, which I think is largely supported just by an aging population and the fact that at the end of the day, schools are about as resistant to a recession as it gets. It's pretty unwed from the broader economy. But the cooling inflation heading into the year, now switching narrative into, unfortunately, probably the likelihood of rising inflation once again, is going to be a huge headwind, because that also stems or flows into consumer confidence. Consumer confidence was already in a pretty weak spot going into 2026, and I'm kind of sugarcoating that because it's basically the weakest we've seen, other than the low point of the COVID era. So I have some concerns about that inflation angle. I think if there's a segment of the market that's buffered from that, your Class A highest income renters are already allocating the smallest share of income towards rent. National number, forgive me for rounding here, but 22% of rent to income, or of income going towards rent. Unfortunately, your Class C residents, national average closer to 25%. There's a number of markets where that's undoubtedly closer to 30%. When the cost of goods and services and transportation goes up as fast as it's going to go up in this oil shock, that does worry me. And I think the biggest worry I have beyond that is if that prolongs itself in an environment where we're already not growing the labor market, you start to kind of get back to the 1970s stagflation scenario again. I'm not saying that will happen, but I do think that starts to peek its way into the discourse. None of us were around for the 1970s stagflation era, but talk to anybody that was, and it was pretty gnarly. So I think fundamentally multifamily, and it remains in a pretty good shape, but there's a precarious set of vulnerabilities that are emerging that weren't in place even as recent as January of this year.
I think it's emerging that the long-term fundamentals of multifamily, are very strong, but just the short-term, not just multifamily, but anything is uncertain. Well, really appreciate that, Carl. Griffin, let's jump right into the jargon bin. Bring us right in, because I think we've got the best guest that we could have for this topic.
Yeah, Carl's got a front row seat to this topic, and I think it's actually is quite timely and mentioning, kind of the escape from the bottom or the uprise from the trough. And so this week on the Jargon Bin, breaking it down on three, different depths of knowledge, just a foundational base of knowledge versus the intro investor knowledge, and then the industry kind of expert. I want to introduce the term absorption into the Jargon Bin, and I'm excited to talk about it. I'm going to introduce a very fundamental base layer of knowledge example that I pulled off the internet today that I thought was awesome. Absorption, it's a quantifier of the supply and demand fundamentals, but it's more so a quantifier of demand specifically in a market. And so as a sixth grade foundational understanding, if I baked 100 cupcakes and brought them to class as a bake sale and I sold 90 of them, that means 90% absorption rate, or 90 of them were demanded or in use or in need of, and they've gotten taken up and they're gone. And that 10 remaining is the number of cupcakes that weren't absorbed. And so I want to put it on you, Carl, to take my cupcake example and paste it over commercial real estate, and more specifically into that multifamily asset class for our base level or entry level knowledge base here.
Yeah. First off, I love that analogy, and I swear I'm not just saying this. I was going to use the analogy of trying to get your fill at a buffet versus getting your fill of like a singular side salad, and that's kind of the way that I like to think of absorption. And I know a lot of people use absorption and demand interchangeably. They're not one-to-one interchangeable. The way I like to look at it is demand is more of like a holistic understanding, both quantitative and qualitatively, of the drivers of some. It doesn't have to be just commercial real estate, but in this case, let's use commercial real estate. The holistic perspective of the desire for a product. We look at the demand for, Spencer, you said this earlier, long-term fundamentals for multifamily remain strong. I look at that as demand. Short-term absorption is going to be predicated upon a number of other metrics, the number of cupcakes you brought to the class. Just because your classmate brought 10 cupcakes and sold all those out, you brought 100 and didn't sell all yours out. Would you say his demand for cupcakes was stronger than yours? Well, no, actually yours was probably stronger, but It doesn't necessarily show that way because you had excess supply. Right. So for me, I like, and I say this hand up. I'm not always good about it. I do try to differentiate between absorption and demand. So absorption, as we measure it, is going to be the change in number of occupied units from period A to period B. But by nature of that, you can only absorb what's made available to be absorbed. And because of that, you see in periods of high supply, absorption almost always follows those supply numbers. They're very autocorrelated metrics. Now, that's not necessarily a good or a bad thing. It's just kind of a nuance in the data. So I guess where I'm heading with this is in 2027 in particular, a number of markets are going to show probably exceedingly weak absorption, if not negative absorption, meaning that your occupancy is probably going to level off in an environment with no new inventory being added. And I think that that's just an important little caveat to add, that the supply demand numbers, while they're important, there's a lot of levels to peel beyond that when looking at, again, the overall health of an industry, or in this case, multifamily real estate.
Right. You just threw out there negative absorption, and that would indicate that there's maybe assumedly a positive absorption. Let's stick on the same level of depth and just maybe briefly describe what a negative absorption rate would indicate in a market versus the positive absorption rate would indicate in the market.
Yeah, so positive absorption theoretically would mean that your occupancy is improving or it's holding stable as new inventory is being added. So if occupancy is 95%, you add 300 units, your occupancy is still 95%, well, that just means you absorbed the 300 units that came on. If your absorption is -5, your occupancy is 95%, and you didn't add the 300 additional units, it really just means that 2 people moved out, and obviously that's not the exact number.
Right, in a bubble, in a vacuum.
Exactly,
Yeah,
just in a vacuum there. So negative, quote unquote, negative absorption isn't always a bad thing. It could just mean stability, unless it's deeply negative. It's different if you're talking about negative 10,000 in a market. Well, that means you had 10,000 fewer occupied units today than you did 1 year ago. But a market like Indianapolis, we're going to see this showing up next year, as early as next year. There's 1,800 units scheduled to deliver. Of those, I think 1,700 of them are in Hamilton County alone. So in Greenwood, if it doesn't add any new supply, your absorption may be 0. Is that saying that demand is bad there? No, it just means that your occupancy held stable and there was nothing else added to be absorbed.
Makes a lot of sense. Do you guys, obviously I play a lot of golf. I'm not sure if you're a golfer when you talk about that, but you have a gross score in golf, you have a net score in golf based on your handicap. I think to dive a little bit deeper into absorption, and I'd like to maybe even bring Spencer in on this, is describe the terminology net absorption and how it maybe differs from what I would call gross absorption or total absorption.
Yeah. So I think that's where, again, it kind of gets into the discussion of, being able to understand, or, making sure you understand the caveats of both comparison points. In all fairness, I think the golf analogy is a great example where the handicap is just kind of a benchmark that you're comparing against relative to some competitive landscape. Your net absorption would almost be like your total number of units that were gobbled up, but your gross absorption would be your, at least as I would look at it, your absorption compared to some set of other parameters, meaning, how many other existing units are out there, or how many units that weren't absorbed.
Right. Okay. Excellent. And I started to throw the golf reference in there. It's always in the back of my brain. The other thing that I wanted...
I have a quick question. Sorry to interrupt, Griffin.
No worries.
I'm curious, since we're getting into this deeper layer, and in context, like I said, 2 quick questions. One, the first is, given, I guess, the current absorption, dynamics in the market, and there's big swings of a large amount of absorption, a lot of supply, but again, that absorption has relatively been able to keep up. Now we're past that supply crest, and absorption is kind of coming down also, as would be expected. What is the current absorption dynamics telling you about where we're going?
To me, it says that there is appetite for new product. That new product's getting absorbed. If there's one downside to using just a baseline absorption number, I think where it misses a lot of nuance is what's happening across different asset classes. And what we're seeing right now is that the absorption, the The baseline number doesn't show this, but if you look at occupancy, for example, what's really happening is absorption is heavily K-shaped, where most of what's being absorbed today is high-end Class A product, Class B somewhere in the middle, kind of pulling up some of the Class C renters that can afford to move up the price spectrum. Class C, I think, is maybe the market segment where we're seeing negative absorption, meaning that there's no new product being added, and you're seeing people move out, whether it be through doubling up, whether it be through affordability, whether it be through deportations and some of the international migration reform. So I think that that's kind of what the absorption numbers are maybe telling us. Not necessarily in that baseline absorption, but if you peek behind the curtain, so to speak.
I think that's really smart to be able to break out, and just in all of these discussions, whether it's talking about kind of the different income segments or kind of class of properties, or we're talking about different geographies. There's just so many different markets. The nuance is so important. Speaking of that, the nuance in kind of segmenting out, there's been, again, so much supply, so much lease up. Assets act differently during a lease up. And going from kind of 0% to 80%, is there some sort of distortion that can enter into kind of your analysis? And how do you think about kind of that lease up dynamic impacting absorption?
Oh, that's so funny. I swear you were there in spirit in the room this morning, because we did talk a little bit about this too. By nature of what we're reporting, whenever RealPage reports occupancy, we're reporting stabilized occupancy. And without getting too into the numbers, that's an 85% property level threshold. So in saying that, and I don't remember the exact number, but in saying that Indianapolis's occupancy right now is 94.8%, what we're admittedly missing out on is the fact that Hamilton County, for example, has 15 lease-up properties that are at 15% occupied. Mm-hmm. Well, by the time you add that into the mix, what happens is there's a gap of, let's call it 300 basis points nationally, where total market occupancy is like 92%, but your stabilized occupancy is 95%. And I know that's a lot of numbers and it's hard to share without a graph, but what's important is that if you look at the delta between stabilized occupancy and total occupancy today nationally, it's actually at its narrowest gap other than 2021 being, of course, that once in a lifetime demand boom. But outside of 2021, it's the narrowest delta between total and stabilized occupancy, i.e., that lease-up absorption is happening. Unfortunately, it's taking a lot longer to reach stabilization among those properties because there's just more inventory being added. Again, it's like trying to get your money's worth at a buffet. Mm-hmm. It's just a lot of inventory to work through. But specific to Indianapolis, the delta between total and stabilized occupancy is now actually at like 50 basis points. So to me, the read is, hey, that big wave of supply that's being added, it's being absorbed. It's taking a little bit longer, but we're getting back very close. We're getting close to a very, very normalized set of conditions. Again, 2019 being the last time we saw that narrow of a total versus stabilized gap nationally. Hopefully that made sense. I kind of went off track there a little bit getting into the Indy numbers, but hopefully that makes sense.
No, I think it
that tracked really well. And so I guess one follow-up to that, because things are taking longer to lease up. I guess the delta is narrowing, but what we've seen, this is just anecdotal, but we'll see a lot of lease up properties that kind of get stuck. In like 70% occupancy, just below like that 85%, or maybe right at 85. As more time goes on, again, should we be thinking about it any?
I would assume he finished differently.
That's my read too. One of the operational challenges that we've anecdotally heard, and I think the data does back this up, is you mentioned the idea of lease-ups getting stuck at, call it 70%. I think one of the things that's not necessarily captured in the data well, but in speaking to folks, is that operationally it's really hard to manage an asset where you've got people moving in today on, just call it a 2-month free concession, while the person that moved in 15 months ago who's now up for renewal is looking at that move-in concession and like, hey, I've been here for 15 months. Why am I being penalized and not being given the same concession upon my lease renewal just because I've been here for 15 months? Like, quite literally, what? Mm-hmm. Yeah, it's it's like, how do you navigate that? What's to stop? If I was in that person's shoes, I'd say, hey, can I just apply? Can I move out and reapply for that 2 month free concession? And totally, like that's 100% a valid experience. So I think that's where some of that stuckness is. I think some good news for lease ups in particular, and really just Class A in general, is that, again, the retention baseline has been risen so much. In Indianapolis, for example, there's an 8 percentage point difference in Class A retention today versus 2019. That's a huge boon to occupancy levels. And I think that some of that you could get into the discussion of, okay, well, does the younger generation just see moving as a higher friction thing? Moving is not fun no matter how you look at it. How many times have we looked at our calendar and like, yes, I get to help my buddy move this weekend. It's just a high friction thing. So, that's something that I'm looking at, is just how that relationship of renter preferences is informing the retention outlook. And again, I'm kind of going off base here a little bit, but it's a set of conditions, especially with lease up properties, that we really haven't seen in a number of years outside of extremely specific examples back in the 2010 cycle, where maybe you had a submarket where this was happening, not multiple markets happening MSA wide.
Wow.
Yeah. Well, and I think we're gonna all be watching those renewal retention rates to see, hoping that they stay. But with that dynamic, again, something we'll really need to pay attention to. Just to keeping an eye on the clock. The last thing I want to ask you about, Carl, is AI. Talking a lot about kind of the agentic workforce, the projects that RealPage is focusing on. Love for you to touch on that, but also just from your personal workflow. I'm just curious, some of these AI tools, whether it's Claude, whether it's OpenClaw, the tools are changing, daily, and you get a lot more work done in ways that never would have imagined, and especially going kind of deeper on the analysis side. Curious if you're doing anything, and then also what RealPage is doing. And and I don't think we know where it's going. So what are you guys doing right now?
Yeah, for sure. So the agentic AI RealPage Lumina workforce, that's kind of been the big focus for RealPage here the past couple of months, or really a little bit longer, but here the past couple of months, it's really gained quite a bit more steam. And it's basically this idea of kind of empowering people to have a new set of tools to make not only better decisions, but just be better equipped to handle what is unfortunately a growing volume of work that we're all responsible for. Personally, I'm not necessarily using AI to the full capacity that I should, but one of the best use cases I've found for it is to ask AI, for example, hey, put on the perspective of a persona within the industry. Here's my talking points for this presentation that I'm sharing. What am I missing? Okay, you don't have anything on loan maturities. You're going to be light on that section. Maybe you should add something on, percent of loans coming up for maturity in 2026. I'm just making that up for example. So that's been something I've used. But I know, Spencer, y'all are doing some really cool stuff here. Kind of creating, and I may be stealing your words here, a kind of a mini Bloomberg terminal, and a lot of that's being done via AI. Now, I don't want to steal y'all's thunder, so correct me if I'm wrong in saying that, but is that something y'all are working on?
Yeah. So that's one of the projects we're working on. That's been really exciting. Essentially, like a multifamily centered Bloomberg terminal that's pulling all kinds of different information in different feeds. And I think regardless of kind of the quality of that piece of software, I think the biggest takeaway is that I did it. Spencer Gray, who has no programming and development experience, or at least I didn't about a month ago. And so just that capacity is, for me, a big game changer to be able to accomplish things that we really weren't able to accomplish before. And I've got a new AI assistant through OpenClaw that I built that's been messaging Griffin and helped us prep for this podcast, and was checking with Griffin while I was traveling to see if he needed any help with anything else. But we mostly have just been experimenting with it, seeing what we could do, and then just empowering our teams to be able to also experiment and see how they can be more efficient and allow them to focus on kind of those higher level tasks that we really want them focusing on. So like Griffin, it's not necessarily copying and pasting data and moving it around and getting a report ready. It's doing this or having conversations with investors, meeting with investors. So we'll see. But excited for the things that you guys are developing at RealPage. Seems really, really interesting.
Couldn't agree more. I think, and just talking with you, there's obviously use cases that you independently can use, but I know you've got a team with you that I'm sure they're deploying AI in different facets and making their lives a little easier at Great Capital. Spencer has basically rolled out entire AI suites for our entire team to utilize, and it's up to us essentially to grab onto use cases similar to you when you're writing your presentations and try to figure out how to make our day more seamless, more integrated with everybody else's day, but also more productive. And it has been quite impressive to watch Spencer walk into the office, whether it's on a Monday morning or it's a Friday morning. And he's excited about what he's been able to build, similar with, other people in our office, like, hey, check this out, look what I'm working on. And so it's now the challenge is trying to get all of that together as a team, so that makes sure that we're all kind of working on independent things that will converge together to build a bigger, better Great Capital multifamily investment platform, property management platform. So I look forward also, like Spencer said, to seeing how you guys are using it and what can come out of it.
Yeah, for sure. No, and I appreciate y'all sharing.
Absolutely. I think the last thing really that I wanted to talk about, Spencer, with Carl was I wrote down a couple terms, and this is coming out of my hat, and this is just not even in the plans, but I wrote down a couple terms, and I wanted to kind of go through them on a national level as well as a Midwest level.
Okay.
And they're all just vocabulary terms kind of across the multifamily industry, maybe even commercial real estate. And I just wanted to have you go through and give me a very brief, concise response or initial gut reaction in regards to the national multifamily market versus the Midwest multifamily market.
I like it. Okay.
So I'm going to start with national supply.
Robust but cooling.
Midwest supply.
Manageable and cooling.
National demand.
Strong, stabilizing, vulnerable.
Midwest demand.
Strong, stable, also vulnerable.
Okay. National vacancy.
Stabilizing.
Midwest vacancy.
Stabilizing.
Excellent. How about national rent growth?
Stagnant.
Midwest rent growth.
Unimpressive, but stronger than the national average.
Excellent. How about national population growth?
Natural population growth.
Yeah.
Modest. Births and deaths, don't necessarily paint a good picture.
Okay.
And we're not getting the immigration flows that we were previously, but it's not like a ticking time bomb either.
Got it. And then the Midwest population growth.
Kind of a different narrative where you're actually starting to get, I guess the Midwest, you weren't as reliant on international migration, which really is why the national numbers have fallen. Domestic migration is actually showing some more positive inflows into the Midwest. I know this is supposed to be short, but
that's okay. This is good.
I think Detroit or Pittsburgh recorded its first city proper positive year of population growth in like 50 years. I think it was Pittsburgh, if I remember correctly.
Awesome.
I know not traditionally Midwest, but you can kind of apply it to the rest. And one other thing too on the Midwest, and maybe I shared this in a previous podcast, but I love that the Midwest has this unique existing infrastructure. Y'all's office here, we were talking about this earlier, y'all's office is literally in an old box factory, I think it is. Mm-hmm. You go to the Sun Belt, and a lot of those cities, historic preservation, quote unquote, is, this building was built in 1960. It's historic. The Midwest actually has like true, unique existing infrastructure to lean upon. So I think that that's something else that, in terms of just quality of a resident experience, not necessarily apartment resident, but just somebody living in a city, the quality of the experience. There's something to be said about having these cool old theaters like the Pabst Theater in Milwaukee, and have Cleveland's ballpark is right on Lake Erie. It's not in some pre-planned entertainment district in suburban Dallas.
Right. No, you're very correct on that. That's a part of the Midwest that I think you don't recognize until you get here and you're in it. You can feel it and see it and touch it. There's a project going on right now that I'm following closely. This is going to be a tangent. There's a young developer who went out and raised the capital from a group up in, I believe, Minneapolis. They are taking a historic downtown Kansas City high-rise structure, and they're converting it and preserving it and restoring it back into a multifamily community. Top floor will be a restaurant bar. They've got the amenities will be really cool, but they've uncovered all of this history in the building that otherwise was covered up over the years. But it seems very cool. Some of that infrastructure that they're uncovering in that building that I've been following along quite closely because I'm keenly interested. Two more things in regards to national versus Midwest, and I'll leave it at that.
Okay.
So I've got national wage growth.
Strong but cooling.
Okay, and then Midwest wage growth.
Strong but cooling.
Okay, and then I'm gonna let you get a little bit long-winded.
Be careful.
In this answer, I just want to know just general affect or disposition on the national multifamily market today, March 25th.
I think it's, and we've covered this a little bit, again, considering all the background economic noise, multifamily has actually been performing relatively well. And I know it's been a challenging market. I'm not trying to dismiss the challenges that many of us have faced, but, considering that there's basically no jobs being added, but you're still getting some household formation, you're still capturing some demand. At the end of the day, multifamily housing provides a fundamental need of a place to live. And not trying to knock other CRE sectors, but people can work remotely. They don't have to be in a physical office in a central business district. If consumer spending drops, how does that affect industrial properties? And I'm not an expert in that field by any means, but I think one thing we've seen in the Sun Belt in particular is I'm hearing a lot of industrial vacancy because consumer spending coming out of the pandemic or in the pandemic was super high for online goods. Well, that's changed a little bit to where, hey, people actually still want to buy things in person. Well, there was a lot of speculatively built space to store the goods that were being were intended to be sold as e-commerce. Retail, a little bit different. There's a lot of different angles we could do in that. But at the end of the day, multifamily housing, people need a place to live. And that's not to say that it'll always be in 100% great condition, but I think just fundamentally the service that it provides is unique. And further on top of that, we continue to be in an environment where there's never been this much of an unweddedness in terms of the cost of ownership versus the cost of renting. And we're seeing residents are renting for longer, both societally driven by delayed marriages, fewer children, having children later in life, and economically driven where it's just an expensive time to go buy a house right now.
Right. You've mentioned a few things that I'm excited to kind of hear about in this Midwest multifamily, your disposition today, March 25th on Midwest multifamily. But you mentioned affordability, and Spencer and I looked into last week the renting or home buying habits or general trajectory and direction of Gen Zers. And there was a lot of the overarching theme of that article was just affordability. And so in the Midwest, it feels like we do have affordability also on the home buying front, but as well as the, rental housing market as well. So when you think about Midwest multifamily and your position or disposition on our Midwest multifamily markets, what do you have to say today, maybe in regard to our markets comparative to the national markets? Does it make you excited? Or is it a little bit more pessimistic?
No, I think it makes me excited, because again, that relationship has been, the cost of ownership has grown significantly outside of maybe, your Youngstown, Ohio's of the world that just have deep population loss, and that's when you're talking about a totally different deflationary set of conditions. I'm not sure how apples to apples the comparison is, but, we weren't that far removed from a Fort Wayne, Indiana, for example. If you were paying $1,500 a month to rent a brand new property, we're not that far removed from an environment where you could get a mortgage for a pretty similar amount, if not even cheaper in some instances. Today, that starter home inventory just doesn't exist. And I think the other thing is the fact that so many people are locked into a low rate that even if they did want to move, it's just the environment to do so is just difficult. So I think the Midwest kind of benefits in its apartment market, I should say, benefits from that relationship today, maybe in a sense in a manner that it didn't in the past.
Awesome. Well, I appreciate you playing my little game that I drew
I love
there.
That. That's a great idea.
Quick hitter questions. But Spencer, I'm going to throw it back to you just for any last burning questions. Then we can maybe put a bow on this and wrap it up.
I don't think I've got anything, Carl. I just really appreciate you taking the time to not only come to the Gray Capital headquarters, but just to come to Indianapolis in general. There has been a lot of renewed interest in the Midwest from operators across the country. We've been talking about it for years, and it's exciting to see. There's a lot of interesting dynamics across the country right now, and you have just been such a thought leader that the entire industry, absolutely listens to and respects. We listen to you all the time. We absorb all of your work, and so just from everybody at Great Capital and the industry, thank you for doing what you do, and we'll have to have you come on the Great Report for a fifth time sometime soon.
Yeah, no, I appreciate the kind words. It's much appreciated, and appreciate the opportunity to work with y'all. It's always a pleasure.
Absolutely. And if you're interested in more multifamily and commercial real estate macroeconomic or monetary policy news and updates, follow us at graycapitalllc.com/newsletter. Sign up for our weekly newsletter, and you can find us right here each week on the Gray Report podcast. Hopefully we'll get friend of the pod, Carl Whitaker, back within the next year for his 5th podcast appearance. And next week we'll have Spencer back in the hot seat here at the headquarters in the podcast studio. Hit that subscribe button and follow along. Thanks for joining us. That's another episode of the Gray Report podcast.